Welcome everyone to ANCAP Radio. It's now time to introduce Inside the Vault from our friends at Strategic Wealth Preservation, the expert in everything to do with precious metals investing. Take it away, guys.
Welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Happy Wednesday, everyone. Welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals and precious metals investing. If you've joined us before, thank you for your support. If you're a new listener, welcome to the show. You can find all of our previous episodes on ANCAP Radio's Twitter account or posted on the SWP YouTube channel. While you're there, check out our Inside the Vault series on YouTube, which is one of the most viewed channels about precious metals investing on the web. We're incredibly excited to expand Inside the Vault in podcast form through ANCAP Radio, so thank you once again to ANCAP for having us on today. I'm your host, Jeremy Varlow, excited to be with you again. We've got a great show in store. We are joined today by Michael Philbrick, CEO of Resolve Asset Management, who will be with us shortly. But Mark Yaxley is with me, as always, to give us his weekly market update. It's been a good week for precious metals. Mark, tell us what's caught your eye in the last 7 days.
Yeah, it sure has, Jeremy. Things are really starting to heat up for gold and silver. Gold prices surged on Tuesday, reaching their highest level since May. Gold now sits firmly above the $2,000 an ounce mark, while silver has also reached $25 an ounce. And that's despite positive developments on the Gaza war front. Gold continues to demonstrate an impressive performance, even though things seem to be improving in terms of the conflict. So one of the major drivers for this recent rally has been a declining US dollar. The USD is now at a 4-month low and has declined 4% in the last month alone. This is a reflection of the growing expectation, of course, that the Fed will be initiating interest rate cuts sometime in 2024. And market analysts seem to agree that gold is poised to continue its upward trend so long as the USD and bond yields continue trending downwards, noting that there are currently no major factors hindering gold's ascent towards a new record high. So really nothing standing between gold's present price point and a new record high. We're really only about 2.5% away from that as of the time of this recording. Turning our attention to silver for a second, it's technically speaking super compressed at $25 an ounce. And I think investors can anticipate substantial upside if the current rally persists. Central bank buying of gold, particularly in Asia, is still on the rise, prompting questions about whether this trend is is linked to a potential geopolitical change in the near future. For example, the shift away from the petrodollar to the petro-yuan. While this isn't a new development or new news headlines, recent events have brought this topic back into focus as of late. And finally, also on a positive note for gold and silver, December, historically speaking, at least over the last 20 years, has been the best month for gold performance. And this is followed by strong historical performances by gold and silver in January and February as well. So all these things combined, heading into the holiday period, I think gold and silver investors should be feeling pretty good about life right now.
Yeah, certainly so, and especially like you say, if we've potentially got a couple more months historically of high prices. So thank you for that, Mark. Obviously, a lot to get to and cover. Lots going on in the markets globally as well as closer to home. I can't think of a better person to give us their thoughts on all of this than Michael Philbrick, who is the CEO of Resolve Asset Management, a provider of global investment methodologies ranging from truly passive to cutting-edge tactical. Mike is also the co-author of the book Adaptive Asset Allocation, Dynamic Global Portfolios to Profit in Good Times and Bad. Mike, welcome to the show.
Yeah, thanks for having me.
So first things first, we always like to give our guests a quick opportunity to introduce themselves to the audience, give a little bit about their backstory. Mike, tell us a bit about your journey to CEO of Resolve. What took you there? I understand you also used to play professional football in the CFL, and you won the 1999 Grey Cup, which I was actually in attendance as a 13-year-old.
Oh, wow.
Yeah, I was there in Vancouver. I'm curious, your backstory leading you to Resolve, and just if how your years on the gridiron prepared you for a career in finance and investing.
Oh yeah, well, let's go back to. Actually, I grew up on a farm in Niagara, and so being a farm kid and learning hard work and all that fun stuff. But I also saved a few shekels along the way, and my dad, said to me, you should do some investing. And so along the way, I had a very early experience in my life with saving some money and buying some stocks. My first stocks were GM, not the GM we have today that's gone through so many reorganizations, but the GM of old and Bright's Wines, which were both big employers in Niagara. I also did buy some silver back then, and still am sitting on some physical silver with a higher cost base than it's today. So let's go silver. But the funny thing is, at an early stage in my life, I started to get interested in the markets and got my 3 shares of GM that I saved up for and checked the newspaper. That gave me an interest in economics. So that's why I went to school for economics. At the same time, I played football. Was fortunate enough to be able to play in the CFL, probably at the benevolence of a person in the Bank of Montreal. Actually was running Nesbitt Thompson at the time, who's a former player, and said you should give this business a try as well. So that's how it all started. And then from the standpoint of what athletics gives you in a sense of how you run your life per se, is that at the beginning of every season, everybody knows exactly what the goal is. In whatever sport you are in, the goal is to win the championship. And you literally have a schedule planned from the first day of training camp to the eventual championship game, where every moment of your time is planned. And it brings that urgency. And I think that's what's exciting about transitioning into the business of finance, is that you have this persistent urgency. You have this constantly changing environment. You have these constantly changing, whether you're talking about football, methodologies of playing, how you might structure an offense or defense. And as well in finance, you have these changing dynamics and changing regimes that are always ongoing and providing, almost an endless source of newness. And you have to have some base of discipline and some thoughtful approach to think through that and not just get carried away on every fad. But I'll stop there because we could go on forever about my history. Let's get to the fun stuff of, everyone should own gold today.
Yeah, there you go. Yeah, I appreciate that about how sports and finance and investing can be kind of correlated. You're not going to win every time. How you pick yourself back up and dust yourself off and change your tactic and evolve. We're going to talk about that in a minute. Now let's talk a little bit about Resolve. For our listeners that aren't familiar with the company, give us a bit of an overview of your mission, your investing framework, and your approach to asset management in general.
Right. So yeah, in that long journey was a journey through several of the major investment firms in Canada and globally. But then you want to eventually kind of want to put your own stamp on things. So myself and my partners, Adam Butler and Rodrigo Gordillo, started Resolve. And really we started with the idea of building alternative asset management type structures. So making sure you're globally diversified, bringing a systematic investment decision process to those strategies. And then also, when you do those things, you can create some nicely non-correlated strategies to complement traditional portfolios. So currently we manage private and public funds and ETFs, as well as bespoke separately managed strategies for investors who are seeking the ability to smooth out those potential returns, and bringing diversity to a portfolio and bringing assets that march to a different drummer, like those of precious metals. They are a classic 5,000-year example of that type of different asset. And then how you might assemble those in a thoughtful way to get smoother outcomes is kind of the ethos of a Resolve Asset Management.
Awesome. Thanks for that. And I noticed, looking at your website, there's 2 solutions that kind of stuck out to me that you call adaptive asset allocation and return stacking. Can you delve into these strategies, how they work together and contribute to the overall investment approach, and what advantages they offer in terms of portfolio management?
Absolutely. So, at core, in our opinion, you want to build an all-terrain portfolio. You want to build a vehicle that can pretty much handle any environment that you might see in the future. And so that comes with, three core concepts. One is diversity, balance, and risk management. And those three things are sort of at the core of building this all-terrain portfolio. The first step is diversifying, making sure that you've got diversity in your portfolio of things that are different. Next is thinking about how you're going to balance those exposures. So the classic, stock bond portfolio that's 50-50 is actually, sort of 90% stock risk and only 10% bond risk. So you have to think about better balance in that situation. And then, making sure that you're managing the risk in the portfolio, that you're not letting we say letting the inmates run the asylum. Rather, you should be being attentive to the portfolio and changing the allocations in order for risk to not run you over. And so that's the core of the adaptive asset allocation strategy, is thinking about a better balanced portfolio with stocks, bonds, and commodities. Stocks are for those growth periods where it's awesome and everything's going well. Bonds are for those growth shocks, and commodities are for those inflation shocks. And then to try and make that all terrain, you want to build some alternative strategies on top where you're using, features and factors that are more akin to maybe a little bit of alpha production. They're very non-correlated, and you're expecting excess return beyond just the betas of the world. Now, where return stacking fits in, and where we've got a suite of 3 ETFs in the return stacking field: return stacked stocks in trend, return stacked bonds in trend, and then return stacked stocks and bonds, which is coming out in the next week or so, where you get $1 of bond exposure plus $1 of stock exposure. So when you're looking at this return stacked stocks and bonds ETF, I'll start there for the moment. Rather than saying, I'm going to move my 60-40 portfolio to 50-30-20, where it's 50 stocks, 30 bonds, and 20% alternatives. Well, what you've done there is you've given up the exposure to that stock and bond beta that you know, love, and trust in order to incorporate some alternatives. What that does is it creates a bit of tracking error, and that tracking error can undermine an investor's discipline to stick to their plan. So rather, let's say we want to add 10% gold to a portfolio as an example. So rather than selling, 5% of your stock and 5% of your bonds to add this 10% in gold, rather buy the return stacked stock and bond portfolio for 10% of the portfolio, selling your traditional portfolio and using that extra capital to buy the 10% of gold, thereby maintaining your stock bond exposure and stacking on top of that some gold exposure. And so return stacking also has, as I mentioned, the two bond and trend and stock and trend. So we think that trend is a great way to have a return that's complementary to traditional betas. So in this case, you've got bonds and trends. So you get a managed futures trend dollar on top of your bond dollar. So as an example there, you take 10% of your bonds, you sell it, and you say, well, I'm going to add the return stacked bonds and trend. Now you have the same $10 of bonds that your 10% of bonds you had, but stacked on top of that is managed futures trend following. So you get the excess return. Now, whether that be positive or negative, you get the excess return of that strategy. So that was kind of long-winded. I'll stop there for the moment.
No, thank you for that. I'm definitely have to listen through it a couple more times just to like completely understand it. But it's a quite, it's a very interesting product and strategy. And you said that you've got the bond and stock ETF that's coming in the next week. Is that what you said?
Yes, sir. It should be trading on or around December 5th, we're hoping.
There you go. Awesome. Well, just kind of piggybacking off of Mark's market update, I'm curious to know what your thoughts are. I know you're a macro guy, looking at the macroeconomic picture, especially considering ongoing geopolitical events, global monetary policy, which continues to be in the news. And, there are fears of a looming recession. What are you seeing out there, and what are your thoughts going into the new year?
Well, I think that right now it seems everyone is a bit complacent. We have all-time new lows on the VIX, so certainly the hedging is something that is gone by the wayside for the moment. We were just talking to Macro Alf on our podcast Riffs, and he was talking about if you reverse engineer what the markets are considering as a potential for recession from the options market, it's sort of sub 15%. So the markets are feeling like the recession probability is quite low. Now, the question an investor has to ask themselves is, where am I with respect to that particular 15% probability? If you think it's 25% probability and you position your portfolio for that, then you're actually going to do better even if the recession didn't occur, right? It just is the probabilities of working through how you're positioning the portfolio. And if it moves from, let's say, 15 to 25, but you still get no recession, you'll still do better. So it's that old adage of it's not what's priced in or what's going to happen, it's what happens with respect to what's already priced in markets. And so I would say from a global macro perspective, whether you're looking at interest rates, whether you're looking at the concentration of the top stocks in the S&P 500, whether you're looking at the spreads of high yield bonds over government bonds, there's a lot there that sort of says my inclination would be that we are likely a higher chance than 15% that something goes wrong and something breaks. And if you think about where markets are positioned in that context, you have, never mind the Magnificent Seven, the Magnificent Two of Apple and Microsoft represent 14% of the S&P 500. The whole energy, real estate, utilities, materials sectors combined only represent 12%. The energy sector, which is what makes everything run in this world, is 5%, sub 5, but about 5, and metals and mining, 0.2%. So if you're thinking about what are the exposures in the S&P 500 that I might own and how will they react to potentially changing macroeconomic shocks and the environment we're currently in, you are horribly underexposed the commodity sector, and really, really underexposed gold as an example, or precious metals as an example, as they are, sort of approaching those old new highs. I will also point out, to complement everything Mark said, is that while it's November 29th, if we close in this range, this will be the highest monthly close for gold. So again, monthly closes, I think a little bit more emphasis can be placed there. Now, while this is not an all-time new high, you're going to get a monthly close high, which is if prices persist in this area for the next day. So I think it's a very uncertain market, yet the markets are acting quite certain. And there are a number of things you can do to provide diversifying opportunities in your portfolio to hedge the downside risk.
It's very interesting. Some of the things that you said there, in particular about Apple and Microsoft versus, energy and commodities. I feel like we were reading the exact same article this morning. Obviously we're keeping an eye on metals prices very closely. We're approaching these all-time highs, and internally here at SWP, we were talking yesterday thinking that, we're going to have a bunch of people that are coming to us and wanting to sell some metals at these prices, given their recent highs. But it was, the exact opposite. Nobody was calling in to sell metals. So it kind of lends a little bit of credence to what you were saying there, that, people are kind of positioning themselves. They might be a little bit wary. So it'll be interesting to see, as Mark mentioned, December, January, February tend to be good months. So we could be on the up and up here. I wanted to continue talking about metals. Obviously, this podcast is focused on the metals side of things. The macro reasons for holding gold are undeniable. Metals seem to have fallen a bit out of favor, however. According to a study that I've read this morning, Bank of America stated that 71% of wealth advisors hold less than 1% of gold. In their portfolios. We've seen central bank
P500, and it's dominated almost all asset classes. And this is the same reason why people have abandoned those diversifiers in their portfolios, whether they be value stocks, whether they be commodities. Money tends to go where it's treated best, and understand where we are in that narrative. And so you're seeing a breakout to monthly close highs for gold, and very few people owning it. Well, that is a lot of potential energy that can continue to flow into that asset, which is a very non-correlated orthogonal asset. Ray Dalio quoted many times, if you don't own gold, you either don't understand history or economics. You get to pick where your deficiency is. And so, it's a classic scenario where you have an underinterested group of investors who have been sort of hypnotized by the previous reaction function that they've had for the last decade in U.S. stocks and bonds. I think about the story that Nicholas Taleb tells in his book, The Black Swan, where he talks about the turkey. And how is the turkey supposed to figure out that the farmer is not his ally before it's too late? Right? How is the investor who's invested or overinvested in U.S. stocks and bonds, who has been treated so well over the last decade, whose friends have done so well over the last decade, how are they to react prior to a regime shift? And they just don't know. Recency bias is informing an overconfidence bias, and the market cap bias, which, market cap portfolios have a much larger exposure globally to U.S. stocks than they've had in quite some time. So again, a thoughtful investor thinking through the different types of regimes that can manifest based on the dynamics of inflation and growth, and looking at gold and precious metals, gold in particular coming into new highs with very low allocations across portfolios, one can paint a very bullish picture in that scenario for this very unique asset class.
Couldn't have said it better myself, sir. We're just running up on time here. We've got a couple of minutes left. I wanted to ask you about tech in general. Humanity, we're witnessing some breathtaking advancements in tech, from AI to blockchain technology. What are your thoughts on the investment opportunities ahead of us in the coming years? What trends do you anticipate shaping the future of finance and investing, as well as asset management from the tech side?
Yeah, it's a really interesting question. And we always have to remember, technology is not mean reverting. Now, prices on technology stocks could be mean reverting, sure, but technology is not mean reverting. And what I mean by that, it's highly, highly unlikely we're going to revert to using the Gutenberg printing press. So we always move forward in technology, and what technology brings us is unknown. And this is the thing where the opportunity for investors to both over and underestimate the potential impacts. And that's where, art becomes a bit of science in trying to figure out how these technologies will change the world. But I think, they are changing the world. If you've looked at the AI adoption, that is outpacing. So it took, I might bastardize this stat, but it took something like 16 years for the cell phone penetration to get to 100 million users or something like that. And it took 3 months for that to happen in AI. And so I think at the moment, AI is not going to replace people. Rather, people using AI will replace people not using AI. And that probably is a set of circumstances that exists for some time. But as AI continues to improve, and we're talking about almost a double exponential expansion in competency in this realm, looking at AI from last November at its launch to today it's not a year's worth of improvements. It's 10 years. And so I think, there's a lot to that. But the implications of that, I don't know what the implications are for the labor market. Are you going to need less people and create more unemployment at some point in the future? How's the interrelationship with crypto, both functionally and as an asset class, going to impact things? I mean, some people have speculated that Bitcoin has sort of taken the steam from gold, for example, because you have this this asset class that was, zero 15 years ago, and now is whatever it is, $1.5 billion. And so that may have taken some of the steam from gold at the moment. So it's very interesting. It'll be very hard to predict. You're going to want to have some exposures in those areas of innovation, and we want to thoughtfully incorporate those in the portfolio. Right now, I think a lot of the market cap indices are doing that in quite a large amount for you.
Yeah, awesome. Thanks for that. I think, from the crypto side of things, we've obviously got all this ETF talk that continues to swirl around. You've got a Bitcoin happening later this year. Definitely in the near term, there's a lot going on in that space. AI is another one that's just fascinating to me personally. I mean, I've got ChatGPT on my phone. I don't even use Google on my phone anymore. I just go to ChatGPT and ask it a question. And, it's absolutely phenomenal and mind-blowing how fast it can render results for you. That's all the time that we have today. I want to thank you, Mike, for joining us. Really appreciated you taking the time to jump on and chat. Like I said earlier, there's tons of articles and research that you and your team have published, as well as your book, Adaptive Asset Allocation. Maybe tell our viewers very quickly before we finish here where they can find your articles and the book.
Right. So the book would be on Amazon. You can find our website is investresolve.com. You can look up the return stacked portfolios at returnstacked.com and return stacked portfolios. Returnstacketfs.com and returnstack.com, where you'll find the portfolio solution suite and the educational articles. So that'll give you the return stack side. Investresolve.com for our website and our articles, and then on Twitter, it's at investresolve, and I'm Mike Philbrick 99 on Twitter for those who want to follow along with us.
Yeah, I definitely encourage everyone to go give Mike a follow. I want to thank you again, Mike, for jumping on with us today.
Thanks for having me, guys.
Cheers. We'll do it again soon. Let's kick it over to Mark to finish the show with his weekly Bullion Basics. Mark, what do you got for us?
Yeah, that was great, Jeremy and Mike. Mike is definitely one of my favorite people on island here in Cayman. He's a gem. He's a beauty. If you get to have a beer with Mike Philbrick, take up that chance. 4 Bullion Basics this week. A question that tends to pop up when the market is either doing really well or really poorly for gold and silver, and that question is, when is a good time to buy gold and silver? People are worried about missing the low. They're worried that they've missed the high, or they're buying into the high. So my advice to people is, timing the market, whether it's equities, bonds, or gold, can be very challenging for most investors, even for seasoned professionals. My advice, therefore, is to allocate and maintain a fixed percentage of your investment portfolio in precious metals at all times. So how do you do that? I mean, step one, you start by tallying up your total investment portfolio. You got to take out your Excel spreadsheet. You got to add everything up. Step two, decide on the allocation that you're comfortable making to gold and or silver. Historically, the number that gets thrown around by wealth professionals will be 5 or 10%. Although some reports, recommend that an allocation closer to 18 or 22 or 20% is appropriate. Step three, whatever your allocation is, act on your plan. You've gotten past, tallying up your investment portfolio. You've come to terms with allocating some money to gold and silver. Now is not the time to pause and worry about buying in at a low or a high. You need to start actioning your plan. It's a long-term plan. Gold and silver are not a short-term trade. If you don't currently own metal, you've got some work to do, and you need to get yourself started on your allocation. If you already own metal, this means you might be topping up your position. The final step, and the most important one, is to maintain your allocation, which means measuring your total investment portfolio value on a regular, reoccurring basis. For some people, this might be weekly, monthly. In my case, for my wife and I, it might, it's more quarterly. We're pretty passive investors. So once you have your total number that you've reevaluated on a regular basis, you're either going to be adding or selling metals to maintain your constant allocation, depending on your current financial situation at the time. That is our Bullion Basics segment this week, Jeremy.
Thank you for that, Mark. I was feverishly trying to find the Charlie Munger quote. Obviously, Charlie Munger passing away yesterday at 99 years old. But it was along the lines of the famous Warren Buffett quote that, time in the market is better than timing the market. And, that just goes right along with your Bullion Basic. That's all for us today. Thanks to everyone for listening, and to ANCAP Radio again for partnering with us. And lastly, to our guest, Michael Philbrick of Resolve Asset Management, for joining us. For more information on precious metals investing, feel free to visit our website at www.swpkman.com or head over to the Strategic Wealth Preservation YouTube channel. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show.